Simplilearn. Your pace, your place.
Financial Risk Manager, FRM. Part 1 of the FRM exam covers the fundamental tools and techniques used in risk management and the theories that underlie their use. Foundation of Risk Management. We appreciate your decision to get FRM certification. You've taken an important step in your career, and we hope this course will not only help you pass the exams, but will be of great help in your career. The entire course is split into 4 parts, and each part has 10 to 12 sections or presentations. Let us begin from the first slide of our curriculum. Agenda. In this presentation, we will learn about risk, the types of risks such as business risk, non-business risk, and financial risk. The entire certification program is centered on financial risk. Financial risk has been further divided into credit risk, market risk, liquidity risk, operational risk, and legal risk. After discussing various types of risk, we will learn how risk is managed, what tools are currently in use for managing risk, and the advancement in risk management. Then we will learn the basics of a very important tool for risk management, VAR, or Value at Risk, its application, and a few examples. Types of risk. Starting from the very basic question, what is risk? Risk can be defined as the chances of having an unexpected negative outcome. Firms are exposed to various sources of risk, which can be business risk, non-business risk, or financial risk. Business risks are risks purposely taken by firms in order to maximize shareholder value and profits. These pertain to risks taken in marketing, designing product innovation, etc. For example, a company can aggressively market its new product hoping to get higher sales. So by incurring high costs in marketing, the company is taking a calculated risk on its own and cannot blame others if the campaign fails. Apart from the business risks, there are also non-business risks on which the firms have no control. These types of risks arise due to shifts in the political and economic environment that may affect the firm. For example, in the late 1980s, the threat from the Soviet Union disappeared and has led to a decrease in defense spending, adversely affecting defense industries. Financial risk is going to be the main topic of discussion throughout the FRM curriculum. This type of risk arises from losses in financial markets due to movements in stock prices, currencies, interest rates. We will cover financial risk in more detail in forthcoming slides. Types of financial risk. Financial risk is classified in various types of risks. Market risk arises due to movement in prices of securities, currencies, interest rates, or any financial instrument to which the company is exposed. The risk can be in absolute terms, such as the dollar value of the exposed risk, or it could be relative, that is, risk with respect to the benchmark. For example, a company that earns index return if investing on any index fund is exposed to relative risk if it invests in any other portfolio. These two market risks are called absolute risk and relative risk, respectively. Market risk may be classified into directional risk and non-directional risk. In directional risk, there is risk due to direction of movement of the price. For example, for a company having funds invested in, say, portfolio X, any decrease in the value of the components of this portfolio will result in loss for the company. In non-directional risk, the risk does not depend upon any practical direction of the price movement. Non-directional risks could be basis risks or volatility risks. Basis risk is the risk that the price of the hedging instrument and the price of the asset being hedged are not perfectly correlated. Volatility risk arises due to chance in implied volatility of the market. For example, if a company has invested in options, then there might be risk due to change in volatility of the market. Options are derivative instruments that will be covered later in the curriculum. Types of financial risk. Credit means owing a sum of money to another party. You must have used credit from banks while using a credit card. If anyone is unable to pay his credit card bill, this will be a default and the bank is exposed to credit risk. Similarly, there can be various scenarios when one party has an obligation to fulfill. Whether there is a change in the ability of one party to honor the obligation, it is termed as credit event. A default situation is the worst credit event. Credit risk is further classified as sovereign risk and settlement risk. Under sovereign risk, a party faces a situation when the change in policies by a foreign country makes it impossible to honor the obligation. For example, a country may restrict foreign exchange transactions. In settlement risk, the risk occurs on the same day when one party makes the payment while the other fails to honor the obligation in return. For example, a party transfers the money into another party's account, but the other party fails to transfer the required basket of securities in return. Types of financial risk. Liquidity risk arises whenever there are transactions of huge size. For example, a company wants to sell shares worth $100 million, but there might not be sufficient buyers for such a huge amount. In such cases, the price of the shares might decline when they might not usually have declined. Alternatively, any buy order for a huge lot might need to increase in the stock price. Such risks that arise due to insufficient buyers and sellers are also called asset liquidity risk. Another type of liquidity risk, funding liquidity risk, arises when a party fails to fund the required amount during times of margin calls or need to increase collateral in a hedged position. The concepts of margin calls and hedging will be dealt in detail later in the curriculum. Types of financial risk. Operational risks arise when there is a management or system failure inside the firm due to poor controls, technological failure, miscalculations, human errors, and other factors that might adversely affect the firm. In many cases, the employees might falsify information and misinterpret financial data purposely. These can be termed as frauds. Sometimes there can be human errors under lack of systematic control and supervision. Another risk, called model risk, arises when firms wrongly apply the financial model for calculating their positions or risk. Types of financial risk. Sometimes there are legal constraints while executing any financial transactions. A perfect example is the case of Procter & Gamble, which had lost $157 million in a complex swap contract, causing a shareholder to file a lawsuit against it. The company had to face legal proceedings before writing off the losses. Such risks are termed as legal risks. Usually, in the case of credit defaults, the party files a lawsuit against the defaulter. The concept of swaps will be discussed at length later in the curriculum. Summary of risk types. Summarizing the various risk types, financial risks are classified as market, credit, liquidity, and operational risks. Market risk could be directional or non-directional. Absolute or relative risks, non-directional risks could be basis risks or volatility risks. Liquidity risks are further classified as asset liquidity risk and funding liquidity risks. Credit risks include credit event risk, sovereign risk, and settlement risks. Finally, operational risks include fraud risk, people risk, model risk, and legal risks. Managing financial risk. Having learned the various types of risk, we see that it is imperative for a firm to have a sound risk management practice. Various tools have been used to manage risk. Advancement in technology and research has brought new tools for managing risk such as VAR. Derivatives have been the most widely used tool for managing risk that are now used to manufacture some complex hedging and structured products. These will be covered later in the course. For now, let's begin with the basis of derivatives. Derivatives are private contracts, and as the name implies, they derive their price from the underlying assets such as stocks, bonds, currency, etc. How the price is derived will be discussed with the help of an example in the next slide. Various types of derivatives in use are forwards, futures, options, and swaps. Each one of these will be discussed at length in separate modules later in the curriculum. Managing financial risk. In the given example, a trader wants to purchase 100 stocks of Microsoft next month and wants to fix the rate with other party now. The rate at which he will purchase the stocks next month from the other party will be fixed now through a private contract. The reason why the party wants to fix the price now is that he does not want to take a risk in case the price increases abnormally next month. Now, how do we arrive at the price of the contract? If both the parties expect that the price will increase in the coming month, then the party willing to sell at a fixed price will agree only to a price higher. Managing financial risk, VAR or value at risk, is the most innovative and widely used tool in the management of market risk. This is used to quantify market risk in absolute terms. The value of VAR gives the worst loss to a portfolio over a horizon at a given confidence interval. For example, if the VAR of the portfolio at 5% confidence is $1 million, then we can say that there is a 5% chance that the portfolio can lose $1 million. Today, companies use the technique to set aside the amount equivalent to the VAR they have calculated in case they are exposed to such loss cases. The conservative companies set aside an amount of VAR that is calculated at a very low confidence level, say of 1%. That is, they calculate the worst loss in 1% of the cases. Obviously, the value is higher than the VAR calculated at, say, 5% confidence. In the upcoming slides, we will see how this value is calculated from the return distribution. Managing financial risk. Many times the companies face risk from multiple sources, and those risks can be credit risk, market risk, operational risk, and legal risk. Also, sometimes the credit risk can be decreased by investing in the market, thus transferring credit risk to market risk. Also, using VAR to measure just the market risk might not be helpful if the company is facing multiple risks. As such, today an enterprise-wide risk management practice is followed, and a balanced approach to managing risk is targeted that aims to limit each of the risks to an optimal level. VAR, value at risk. In slide 12, we have learned the concept of VAR. In this slide, we will see how a typical VAR calculation is done. In the given diagram, the return data of a stock is plotted. We see that most of the data is centered on the mean, and the number of observations for extreme returns diminish rapidly into a tail as we move further on either side of the return. Suppose that we segregate the worst 5% of the returns and find that 95% of the observations have a return of more than minus 10%. That is, only 5% of the observations have return below minus 10%. This means that if we rely upon historical data, then there is a 5% chance that the loss could be more than minus 10%. Hence, if we want to be 5% confident, then we can set aside this value as a safe limit. The exact dollar value can be obtained by multiplying 10% with the total portfolio value. That is, if the portfolio value is $150 million, then VAR at 5% confidence will be 10% of $150 million, that is, $15 million. Extreme market movements. Several recent and significant events have increased the market volatility and led to growth of risk management industry. Here are the examples of such extreme market events. 1973. Stocks to oil price, high inflation, volatile interest rates. 1987. Black Monday. Minus 23% decline in US stock prices. 1997. Asian contagion decimated Asian equity markets. 1998. Russian debt default and the collapse of LTCM. 2001. September 11 attacks on World Trade Center and the 2001 US equity market collapse. 2007 to 2009. Credit crisis resulting from the mortgage market meltdown and huge amounts of bank leverage. Increased market volatility caused significant financial losses, which could have been avoided by appropriate use of financial risk management tools. Firms also have become more exposed to economic and financial variables due to bank deregulation and globalization. All these have led to the growth of risk management industry because financial institutions are now exposed to a wide variety of risks. Functions and purposes of financial institutions. Financial risk management is the process of detecting, assessing, and managing financial risks. Financial institutions serve as financial intermediaries for managing financial risk. As part of this function, they create markets and instruments to share and hedge risks, provide risk advisory services, and act as a counterparty by assuming the risk of others. Other risk management tools. A stop-loss limit seeks to limit the amount of loss on a position by eliminating the position after a cumulative loss threshold has been exceeded. Notional limit of a position is a limit on the notional amount invested in a position or asset. Exposure limits are limits to risk factor exposures. VAR is an ex-ante measure and captures exposures to risk factors and accounts for covariation in risk factors. VAR is comparable across different business units with different assets and risk characteristics. Valuation and risk management using VAR. Valuation is the process of discounting the expected future cash flows of an asset to determine the current price. So, the expected value of an asset is the mean value for the distribution of possible values. VAR is a risk management tool. Estimates the future distributions of asset values with a focus on the lower tail of the return distribution.